Hi there, this is Evelyn here. Today I am talking about the profitability versus the liquidity trade-off. What does that mean? Well, profitability versus liquidity means increasing your profit at the expense of being liquid. Being liquid does not mean turning into water. Laugh out loud. But being liquid means how much cash you have. The more cash you have, the more liquid you are. In business, there are a couple of things that actually prevent you from being liquid. One of which is having too much accounts receivable, having too much inventory, having too much accounts payable, and having huge amounts of loan because the current payment stops you from being liquid because that's cash that has to go out in the current period. Now let us go to the workbook. The very first thing you need to do when you get to the workbook is enter some data. This is simple enough. The first thing you do is you enter your sales, and this is an estimation based on the fact that you expect to if you offer no credit, this will be your sales. So for example, in this case, if no credit is offered, the sale is expected to be $260,000. However, if credit is offered, then they expect to increase their revenue by another $300,000 to make it $560,000. And then enter the percentage of above paid in cash. So if basically you expect no cash payment from this current period sales, you enter 0%. Then obviously, if you have accounts receivable, you'll be collecting from prior months. So enter the estimated amount you expect correct from prior months. And then enter your beginning inventory, what you had before you enter the current period, what you expect to have at the end of the period, and enter the amount, the cost of goods sold percentage. So for example, if you buy a product for 10 and sell it for 20, your cost of goods sold percentage is 50%. So in this case, it's 45%. Lastly, you enter the percentage of purchases that you pay in cash. So any inventory that you pay right away, if you don't pay anything right away, then it's 0%. But if you pay, like, if some vendors require you to pay, right away, then you enter that percentage. So if it's 50%, you put that in there. Then you write the payments that you're making for prior months, and then you enter any other cash expenses you expect to have in the current period. Next becomes with profitability versus liquidity analysis. Here we see our net income based on the previous scenario will be $256,000. Our revenue will be $260,000 without the credit sales. With the credit sales, it increases by $300,000. Our cost of goods sold will be $252,000. This gives us, and then by the time we subtract the other expenses, we have a net income of $256,000. On the other hand, we don't have enough cash to finance our business, so which means we'll have to find some loan somewhere. Our cash is a negative $51,000, and that's mostly because we are not collecting our cash, our cash from sales. So obviously here you want to balance it out. If you have a good source of loan to help you finance the accounts receivable, obviously this will be a good choice for you. But if you don't, you have to look for other options where you can balance the cash/accounts receivable. So here we go back and we change the percentage of above cash collected to 50%. Let's see what happens. So we can see that our net income has gone down to $162,500. But however, we're cash positive. We now have $59,000 in cash. So again, it's a balancing act between profitability versus liquidity. How much net income do I want versus how much cash do I want? The more accounts receivable you give, the bigger your sales become. But on the other end, you have cash problems. So you have to find that balance. Going back to our prior example when we had 0% cash collection, so we had 100% account receivable. I want us to look at one more problem that happens when we have cash problems. The problem with having cash problems is it multiplies. So here we can see average daily cash receipts of 67. However, our operating cash needs of $2,067 on average. Then we have a deficit of $2,000. So let's see how that plays out. So here we can see on day one, we're negative. We keep on being negative. So eventually, let us say we try to get a loan for $73,000 so we can just get in the positive. We do that, but because our average daily cash is negative, we're always in the hole. So let's say here we take another loan of $2,000, and then it's just going to keep us for a little while, but then we have to get a loan. So when your average daily cash receipts is on a negative, The biggest problem you have is not the fact you need a source of financing. The biggest problem you have is your expenses increase, because now you have to acquire more loans, which means more interest. Then, not only that problem, you also have to always be playing catch up. And as a matter of fact, you can never play catch up if your cash receipt is negative. It just never happens, because you can never add negative to a positive. Mathematically is not correct. So if this is your problem, you really need to restructure, or you need to shut down the business if it's not possible, because there is no way you can ever catch up. You're always going to be stressed because of the lack of cash.